All right, good morning, everyone. This is tax considerations living or working or abroad. My name is Jeremy Vaida, and I'm joined today by my esteemed colleague, Mark Schweighofer. And as the title suggests, we're going to be talking about tax considerations when we are living or working abroad, with its particular focus on Israel. Just kind of by way of short background, Mark and I both work at Stein Sperling and our federally recognized tax group. And Mark and I are sort of the two that deal with the more internationally focused matters as they relate to tax and income reporting. Like I said, we're going to be talking about living and working abroad. But just to be clear, this is what we're going to be discussing are rules of general applicability. So they apply to basically wherever you're going to be living, whether it's Israel or Mexico or France, any place internationally. But to the extent that there are sort of specific rules that relate to Israel in particular, whether they touch on the Israel Income Tax Treaty, those will kind of get highlighted here. So if you don't have Israel-specific concerns, this is a presentation that's still going to be of use, and it'll be sort of extra useful for those who are considering a move to Israel. We're going to be highlighting some of those rules. Now, that being said, even before one sort of uproots themselves and moves abroad, there are sort of things that individuals should consider, whether you have family living abroad already, or whether it be children or other folks, maybe you've had accounts overseas, or otherwise kind of have general entanglements abroad. We're going to sort of first focus on U.S. persons situated in the United States with an outward focus internationally. So even before moving, what are the kind of things that you should consider? So with that, I'm going to give it over to Mark to kind of lead us off with that first segment.
Yep. Good morning, and Jeremy, thank you very much, and good morning, everyone, and thank you all for joining us this morning or this afternoon or evening, wherever it is in your part of the world these days. Definitely interesting times that we're all living through. And yes, so as Jeremy mentioned, he and I work very closely in assisting our clients that have international tax considerations, and that really spans the gamut. It's either folks who may have lived overseas for a number of years and maybe got behind on their U.S. tax reporting and need to get caught up. It may be something along the lines, and a fact pattern we see a lot too, are folks who are, who were either born in the U.S. Or lived in the U.S. for a very short period of time and have moved abroad and haven't filed, and now they're starting to see some of the clippings in the press and some of the hearing tale of pretty aggressive IRS enforcement on various aspects of U.S. persons living abroad and not filing income tax returns, or not filing and disclosing certain financial interests or business interests abroad. And the penalties can get kind of staggering. So we work very closely with our clients to kind of get them back into compliance in the most efficient way possible, seeking to minimize penalties, and also just then kind of, and once we get that part done, you kind of pivot into phase two. And for maybe some folks who are considering a move, it could be phase one, which is, we're not looking to correct the past at that point. We're looking to sort of do some tax planning and make sure everybody's aware of the rules of the road as you move, whether you're moving abroad or moving back, or if you are abroad and considering investments here in the US, those sorts of things all have very large tax considerations that, sometimes are as important as the underlying economics. So I did want to point out, I know some of you have submitted questions already. I think Jeremy and I are going to run through the presentation first, and then we will turn to those. But if any of you have specific questions or want to get into something above and beyond what you've submitted already, feel free to add it to the chat box there. And we'll try to answer those in due course. And if there's a need to sort of unmute folks and have a discussion on it, we're happy to do that too. So the hour's really for you all, and want to make sure we're getting, you're getting as much out of it as you can. And this is obviously an ever-evolving area of the law. The world is shrinking, particularly, and there's a lot of new considerations that we didn't have, even a few months ago, when, given sort of the transition to remote work, and how that's impacted folks living and working abroad as well. So we'll touch on all that, and by all means ask questions, and I hope you find the presentation informative. So with that, I will hopefully talk about some of the things to consider, again, for taxpayers before they move abroad. So one thing that I think probably everybody should be aware of before we even get into the stuff on this slide is, if you're a U.S. citizen or a U.S. green card holder, or someone who has been a U.S. permanent resident for a period of time, before you move abroad, make sure you're aware, just because you're outside of the borders of the United States doesn't relieve you of your obligation to file tax returns here. There is a delayed filing for that, so that can be, that it can be done. You have actually till June 15th if you're outside of the country, and you can extend that till October. But you still have an obligation to file. In the international space, one of the areas that really has gotten probably the most publicity of anything in terms of the IRS enforcement is the foreign bank account report, or an FBAR. Quite simply, what this is it is a separate reporting requirement. It's separate and distinct from your tax return. It's filed electronically. Didn't used to be, but it is now. It is due at the same time as your tax return. If you extend your tax return, it is also extended until October 15th. So if it's either it's technically due in April, but with an automatic extension till October 15th. And basically it's a pretty broad category, a pretty broad reporting regime. It's anyone who has a financial interest in or signatory authority over a foreign financial account that is located in a foreign country, provided that the aggregate amount of all foreign accounts exceed $10,000 at any time during the year. So even if you have 10,001 accounts, all with $1, even though none of them have $10,000 in them, you have a reporting requirement. Similarly, if you have an account that and you see this a lot when people are buying residence abroad, where you see a large transfer of money into an account, just perhaps from the US or otherwise, hits the bank account for a day. Sometimes it's not even a transfer from the US, sometimes it's just a mortgage borrowing. It hits the bank account for a day, immediately gets wired out to the buyer. That still is enough to trigger the FBAR filing requirement. Another kind of gotcha to put make sure everybody's aware of is, if you're filing jointly with a spouse, unless you have completely overlapping accounts on all of your foreign accounts, you each have a separate filing requirement. So you can't. So in that situation, husband and wife would each have to file an FBAR, even though 95 or 99% of their accounts overlap. If husband and wife have one account that is separate, then you cannot file a joint FBAR in that situation. And then the last gotcha, I guess I want to make sure of, is if you have a company or a trust or something like that is set up that has an account overseas, and you have signing authority by virtue of being an officer of that corporation or that LLC or that entity, or as being a trustee, you need to report that you at least have signatory authority. There's a separate section on the FBAR that says signatory authority, but no direct financial interest. So so all of those, that's sort of the broad categories of things that need to get reported on an FBAR. And again, this is a separate filing, separate and apart from your tax return, due the same time. And there is a box on your tax return that on Schedule B that needs to be checked, as well as the first bullet point indicates, that kind of alerts the Internal Revenue Service that this is there. Failing to check that box has really caused problems for taxpayers over the years, because it kind of evidences the fact that they may have misled the government, whether with respect to what they had overseas. So why do you care about this? Well, the penalties for failing to file an FBAR are pretty staggering. They start basically at $10,000 per account per year. In recent years, the IRS has sort of relented a little bit on that, and now the penalty for most non-willful violations, meaning they don't feel the taxpayer was actively trying to mislead or conceal the existence of the account, typically, they end up with a $10,000 per year penalty, but the IRS has 6 years through which to audit the filing of foreign bank account reports. So even if you don't have, even if you have a situation where, you sort of were just negligent in not filing, if you have that happen for 6 years, sort of right out of the chute, the IRS's starting point will at least be $60,000 in penalties that we're trying to fight our way back to the middle on. So it gets, it can get pretty expensive pretty quickly. And then obviously, if they think there are bigger concerns, the taxpayer was active in terms of of concealment, or something that, kind of trends more towards being willful in terms of not reporting your FBARs or not being truthful, then the penalties can be as much as half the account balance at any point, the highest account balance during that look back period, which can be obviously a very crushing penalty to most folks. And and if it's egregious enough, and you will find the cases, you will find cases that the courts have looked at in the past, and it's usually very elaborate schemes kind of set up by taxpayers really trying to conceal both income and the existence of their accounts. That can lead to criminal penalties as well. So just be very cognizant of that. Just know that that's there. Make sure that when you're looking at Schedule B, talk to your CPAs or your tax preparers. Just make sure that they know what's going on when that, so that none of these things kind of get missed inadvertently. Because, like I said, even inadvertent violations can cause significant monetary problems. The second form that I wanted to mention that gets reported, that pretty much any client that I've had that is overseas for very long has to deal with, is a Form 8938, and that is sort of the tax return equivalent of an FBAR, if you want to think about it that way. This form actually does get attached to your tax return, and it covers more things than the FBAR does. But it has a much higher threshold for reporting than the FBAR does. The FBAR, the $10,000 in the aggregate, that came in the 1970s, and they've never adjusted that for inflation or otherwise. It's just always been $10,000 in the account. For the 8938, it is a much higher threshold. You can see those on the slide. If you have folks who live in the U.S. and they have foreign accounts, if you're single, it's $50,000 at the end of the year, or $75,000 at any other point during the year. Basically doubles if you have a joint return. And then look at the threshold is much higher if you have somebody who's living outside of the U.S. So it's basically a $200,000 for married filing single, or for a single filer, or $300,000 joint, or 300,000 at any point during the year. And then if it's a joint file, those thresholds also double. So a couple of things with the 8938 that bear repeating. It does include bank accounts. It does include brokerage accounts, just like and the FBAR covers both of those too. It will cover foreign pension accounts. The big thing that the 8938 covers that the FBAR does not are things like private stocks and individually held securities. So, if you own, and we'll just, if you own just a single share of stock of a private company located outside of the US, and your other assets otherwise push you above the threshold to file an 8938, that share of stock needs to be listed and its value on the 8938. And again, and things like foreign partnership interests fall in that category. If you've lent money to somebody who lives outside of the U.S. and they give you a promissory note back, that falls under the 8938. So there's, just be careful when you have, when you have some of these situations. And this is, where we've seen this come up a few times, where we've had folks in the U.S. with relatives abroad where they've lent money and there's a note back. And that in the 8938 threshold gets missed. Now, in that situation, you're usually able to negotiate some with the IRS if they see it, but it is, because the guidance is sort of evolving. This is a much newer form. It came out in, I think, 2012 was the first year that it was incorporated into a tax return, but it is an area that the IRS sort of fixates on. And the problem is, because the FBAR and the 8938 are, they cover so much common ground. The problem is, if you have a problem with one of those two forms, you almost certainly have a problem with the other. And so, you kind of end up with a double whammy in that situation. The 8938, if that's supposed to be there and isn't, or if it's materially incorrect, that also carries with it a $10,000 penalty each year. So that's not like a per account form or per account penalty like the FBAR is, but it is a per form penalty. And so they can stack pretty quickly, and the penalty escalates if it's not paid upon demand relatively quickly. The other big thing that's important, if you have to file this form, if it's supposed to be included in your tax return and it isn't, is it changes the time period that the IRS can come back and audit you. Normally, when you file a tax return, the IRS has 3 years from the date you file it, or the due date if that's later, to which to come back and examine the return, ask questions, make adjustments. If you're supposed to have had this 8938 on the return and it was not, and this is going to be the case for a lot of the other forms that I'll touch on at a very high level, after these first couple of slides. If this 8938 is supposed to be there and it isn't, that 3-year clock never starts to run, ever. So from the IRS's position, it's basically just like you never filed a tax return, even though you've given them a lot of information about yourself. If this isn't there, if they find a problem in a later year, and we've had this happen, frankly, where a taxpayer took an aggressive position in a subsequent year, that return got audited, the 8938 filing requirement was missed, and we ended up going back, and the IRS ended up going back to years that the taxpayer had thought were have been closed years, and we ended up having to fight about those penalties too. And in a couple of the cases that I've been involved with, we had to pay fairly significant penalties, even though there was really nothing wrong with the returns themselves for that year. Most of the income had been picked up. It was just purely a situation where the 8938 wasn't attached to the return. Okay. Sorry, I'm going to gradually transition this. This slide is very helpful, I think, for both taxpayers who are looking at moving abroad, as well as their tax preparers and their advisors, because this chart actually comes right off the IRS website. They update it periodically, but it gives you a very good sense of what assets need to be reported on an 8938, what assets need to be reported on a FinCEN form 114, which is the FBAR form. And you'll see as you go through it, a lot of the responses are the same. There's a few that are different. It's important to know which ones are which, and where you're reporting it. Note that one of the things that's not reported on here is this last one, and this will come up a little bit because foreign pensions create some issues generally, and Jeremy will speak a little bit more in depth on that as he provides his portion of the presentation this morning. But things like Social Security benefits and that sort of stuff are the equivalent, basically the foreign equivalent of our U.S. Social Security system. Those are not required to be reported. But one thing that I did want to highlight too is foreign-owned real estate. And we'll talk a little bit about real estate as well. If you own real estate abroad in your own personal name, it doesn't end up on either form. If it's like here in the US, you know, if you were coming to see me in the US and say, look, I want to set up, I'm going to buy an investment property that I'm going to rent out, my advice would be that we should put some sort of a limited liability vehicle, probably an LLC, around that to take title to it so that your personal assets don't get exposed. It's no different in many of the other foreign, in the foreign country. So you'll do that again to provide the liability shield. Now the real estate, if it's held by an entity, does not need to be reported on an FBAR or an 8938. But the real estate, but the ownership interest that you have in the foreign entity that holds the real estate will at least need to be be included on an 8938. So just keep that in mind and be cognizant of that as you sort of set up your affairs as you're moving abroad. Okay, come on, here we go. There's a few other tax forms which we're not going to get into a great deal of depth here. You know, it's sort of inside baseball in the tax world on a lot of these. But basically, if you have, I just kind of highlighting this because if you have a situation where you have a foreign trust or you're setting up a company abroad, or you have a foreign company that's going to purchase, you know, that's going to own an interest in a U.S. company, there are additional reporting. Just think if there are any sort of business relationships between a U.S. person and a foreign company, or between a foreign company and a U.S. organization, like as a subsidiary or otherwise, just make sure your ears kind of ring a little bit on that and think about, well, if that's the case, you know, I sat on this presentation back in October of 2020, and they said, look, that we might have some additional reporting requirements that go along with it. And again, the return, these forms themselves are very complicated. I certainly recommend using a CPA who is familiar with foreign reporting and international taxation. This is not the type of thing, even on what seem to be relatively simple ownership arrangements and simple organizations. If you have a CPA who doesn't really deal in this space a lot, my experience has been you end up paying more to either kind of educate them on the fly, or you pay more on the back end when we're trying to get it back into compliance than you are if you need to, if you use someone who is well qualified on the first instance. That's sort of a plug. Jeremy and I we don't prepare returns in our office, so we're not the ones putting these forms together. So we don't really have we don't have a dog in the fight on that, but it is something, we're happy to make recommendations to folks we've used and to folks that we trust and that know what they're doing. The messiest situations that I've found typically end up in, where somebody used a preparer who wasn't qualified, and it's been years, and now we're in a situation where we're trying to unwind some things or go back and re-report it, and it gets very difficult to do. Okay, so I'm just going to talk very quickly about a couple of them, and then I'm going to turn it over to Jeremy, who's going to talk a little bit more about sort of the tax and Social Security ramifications of folks working abroad, and some of the considerations there, and then we'll talk a little bit about some of the estate planning issues too, because that's also a big consideration for a lot of folks. One is the one form that I do want to highlight is this form 3520. This really serves two purposes. The first one, which I won't get into a lot of, deals with ownership. If somebody is considered an owner of a foreign trust for tax purposes, if there's a foreign trust overseas that's been established, and this happens, family members set it up. Sometimes they set it up and they name someone a beneficiary. If that beneficiary ends up being what we call in the tax world a grantor, under a grantor trust analysis, that triggers this filing requirement, and it needs to be done on an annual basis. The penalties can be quite excessive. This gets filed separate and apart from your tax return. But the other one that I think probably I see missed more than anything else is a situation where you have a US person, doesn't matter if they're abroad or if they're here in the US, that receives a gift or a bequest or an inheritance from somebody living overseas, either an individual or a foreign estate, in excess of $100,000 again in the aggregate. So that's a situation where, you know, you're living here or you're living abroad, and you have you're a father or a grandfather or an uncle or something who gifts you money to cover living expenses, go to college, whatever. That triggers this reporting requirement, and it's a big and if you miss it, it's a really large penalty. It's a greater of $10,000 or 35% of the gift received. So essentially what that does in the U.S. tax system, typically the recipient of the gift doesn't pay gift tax or doesn't pay any sort of transfer taxes. For gifts of U.S. property, once you're above your estate tax exemption, which is currently $22 million, if somebody makes a gift, they will pay tax on at a 40% rate on the value of the gift. So essentially what this does, though, is this regime, because they can't reach the foreign person, typically the US government can't reach the foreign person to tax them, this regime sort of turns that this statutory scheme turns that regime on its head and says, okay, as a U.S. person, you got a gift from somebody living overseas, who's a non-resident alien, in excess of $100,000. You didn't report it. We're basically going to charge you a penalty equal to 35% of the gift that you received. So just be very cautious of that with gifts between different, gifts between family members and otherwise. It can also happen in situations where and where we see it often too, is someone's is a U.S. citizen and they're living abroad. And they have, the family members living abroad are supporting them, giving them gifts to help with living expenses, those sorts of things. None of it never hits a U.S. account. Nobody really knows, you're kind of it's not top of mind, but just be very cognizant of that as you're going through it. Okay. And then these next two, I'm going to not really dwell on, because this is really more for folks who have, if you have an ownership interest of a foreign corporation, so, you're a U.S. person, you own a company that operates, that's organized outside of the U.S. and operates abroad. One thing you just need to keep in mind is, depending on, here in the U.S., if you have a U.S., what we call a C corporation, it makes money. Unless it pays you a salary or unless it pays out a dividend to you, you're not paying any taxes on the earnings of that company. The international rules are a little bit different from that. The US government has always been concerned that US nationals will set up companies overseas, let the company make money and kind of park it there, and then sort of extract it in a way that the IRS finds harder to detect. So there are a series of rules under in the international tax arena that basically say you can't do that. And so they're going to look at it depending on the type of income that the company earns. Even though you didn't, as the owner of the company, even though you didn't get a distribution or a dividend or pull it out as a salary, if it's of a certain type of income, and there's a couple different regimes that are applicable in this area, even though you didn't get anything, they're going to tax you as if you did. So this is an area, and it's gotten more complex in since the passage of the Tax Cuts and Jobs Act in 2000, at the end of 2017. It's gotten a lot harder to sort of defer income earned by foreign corporations overseas. It's not impossible, but it's gotten a lot harder. And in addition to that, it's made the reporting requirements much, much more complicated. I'll just tell you that the clients of mine that have had what I consider to be relatively simple operations overseas, have gone from seeing their foreign reporting obligations, just in terms of the compliance costs to advisors, go, at least in the first couple of years from, historically it was, $7,500 or so to prepare the return. And now it's easily close to 20,000 in a lot of cases. So just because there's a lot more detailed reporting that the IRS is requiring. So with that, I think I will turn it over to Jeremy to go through some of the considerations about working abroad.
I mean, we're going to talk about working abroad. So now all these things that Mark was talking about is applicable to U.S. persons, whether or not they live abroad. So that's something that is important to know. You don't have to be living abroad to have FBAR requirements or 8938s or anything like that. Those are all, it's your requirements as a U.S. person. On the other hand, once you move abroad, there's sort of a whole host of other considerations for you to talk about. So first, we're going to talk about kind of the working person. So you get up and you take advantage of one of these. I think you can go to Bermuda now for. You can stay there for nothing, or $300 or something, and you can live in a Caribbean island for the indefinite future. For whatever reason, or you've decided to pick up, make Aliyah, move to Israel. Now you're abroad, and you gotta work to live. So I mean, the two sort of main categories that exist are sort of the same kind of two categories that exist here at the stateside. You're either going to be an employee or you're going to be an independent contractor. If you are an employee, generally speaking, it's a relatively simple affair. It's also going to be reportable. In this line one, same place you would put wages for if you were working stateside, you put those same wages, whether or not even though they're earned abroad. So in that respect, they're sort of indistinguishable from U.S. wages. The main sort of departure has to do more with foreign retirement accounts. And we're going to get into this into depth later, but it's something that you sort of have to be on the lookout for, because a lot of these foreign retirement accounts fall into what's called this PFIC regime, which effectively eviscerates a lot of the tax preferred benefits of these retirement plans. Just like how we have tax preferred vehicles in the United States to encourage people to save for retirement, most, at least developed countries abroad, have similar type regimes, but these rules sort of circumscribe that and take away a lot of the benefit, the tax benefit at least of those products. The other thing to sort of consider, I mean, this is kind of the reverse, but when you're talking to sort of your employers, or if you're working with someone, you want to move abroad, and you're having a conversation with them, one thing that your employer is going to want to consider is whether or not they want to keep you as an employee. Now, if they already have international operations in the place where you're going, it's probably not a big deal. But if you're getting up and moving to a jurisdiction where they don't have a presence, you being there as an employee will essentially create a physical presence for that foreign company, which creates a whole cascade of tax and reporting obligations, like all the same kind of things that your employer would have to do here: sign up for Social Security and comply with labor laws, and minimum wage requirements, all sorts, unemployment insurance, all these sort of different things that business owners have to deal with in the United States. As soon as you have a physical presence in a foreign jurisdiction, you have to comply with all of their rules. It almost certainly requires you to solicit local counsel to deal with it. So just when you're making that move, it's something that you and your employer want to negotiate or discuss before you move over there. Almost certainly, unless they already have a physical presence over there, they would prefer that you be an independent contractor. Or perhaps you get a gig when you're just there as an independent contractor because the sort of migration to the gig economy, freelance work. It's not uncommon that ends up being kind of the these days, fortunately, unfortunately, the kind of default. The main issue here, and specifically with regards to Israel, this is a huge issue, has to do with again with retirement, but this case with regards to Social Security payments. Now, I mean, generally speaking, just like with um, uh, a domestic independent contractor, you're going to fill out a Schedule C and also a Schedule SE for self-employment income. That's sort of basically where independent contractors report their income for Social Security. They're effectively both the employer and the employee. And so they have a separate form to report all that. Unless there's a totalization agreement with the United States, that exact same regime persists even though you are no longer physically present in the United States. So this is a major problem because Social Security taxes, when you include Medicare and Medicaid, and Social Security, is up to 15.3% on the first dollar. It's not like the income tax. This is a wage tax on the first dollar. And when you add that to whatever the local Social Security regime is, in Israel, it's upwards of 17%. You're talking about now over 30% of your income being contributed to taxes from the first dollar, even before we're talking about income tax. So even even like a relatively low wage person who's just kind of trying, I know a lot of translators or the kind of gig work that you're not making huge dollars here. To start off with over 30% of your income being given to the government is a lot. With Israel, this is a major problem because it doesn't have one of these totalization agreements, which essentially kind of harmonizes these things. If a country, in the UK, Canada, a lot of developed nations, a lot of European nations have totalization agreements, which essentially harmonizes this to kind of eliminate the double tax problem. I mean, the US has income tax treaties with a lot of countries, but it doesn't necessarily have this Social Security agreement with everyone. And so Israel, Mexico, more developing countries, or just kind of other countries, Russia, China, India, all of these places don't have totalization agreements with the United States. So the question is, what do you do? Let's say you don't want to, hand over 30% plus of your money to two different governments on the first dollar. What do you do? The main sort of planning technique in this area is to form a foreign entity and make yourself an employee. Now you've essentially solved the problem. You've turned yourself from an independent contractor back into a wage earner. So now you don't have to file this form Schedule SE. You don't have to deal with this U.S. Social Security problem. You'll of course have to pay Social Security in the foreign jurisdiction, but that's you're going to do that no matter what you're doing or who you are. The issue with forming a foreign entity is that it's a huge pain in the neck. There are, I mean, even you can create a company in the United States relatively easily, and depending on the foreign jurisdiction, formation can be relatively easy. But as with anything, there's ongoing sort of upkeep and compliance costs. You have to file yearly reports. You'll likely need a bookkeeper, if you can't do it yourself, especially if you don't necessarily speak the local language right away. You may not be able to do the kind of bookkeeping yourself to be in compliance with foreign law. And then, of course, you're going to almost certainly need an accountant to deal with sort of year-end stuff for the entity. So, I mean, this is, if you reach the cap of Social Security, which is $137,700 this past year, this is like a 20,000 plus issue. But this is really something, it's a cost benefit analysis, because on the higher end, basically, is it going to be cheaper for you to deal with the compliance costs of essentially hiring yourself as an employee and operating in that way in the foreign jurisdiction, or are you going to pay double tax? So, I mean, those are sort of the two things you have to weigh to yourself. Basically, the more money you make, the more of a problem this becomes. And the closer you get to the cap, the more incentive you have to kind of plan around it. If you're not making much, then the cost it would take for you to accomplish this is probably not worth going through with it. So that's sort of the main. Okay. Now this was Now this is something that's important. It was a question that came in sort of before the presentation. as well is income apportionment. Where is the money, where is the source of the funds coming from? Let's say that you're a foreign person, but you have a US based employer, or a US based contractor. You're an independent contractor, but it's all coming from from US companies. Nevertheless, even though the money is sort of coming from the United States, the source of that income is actually where you are physically located as a service provider. So, and the tax treaties make this clear, that income is sourced where the service provider is physically located. The thing you have to really kind of be on the lookout for. So, I mean, as a default position, if you're 100% of the time in a foreign jurisdiction, even though you're working for a foreign employer, all of your income is going to be sourced in this case, like to Israel for the work that you provide. The sort of wrinkle is, what do you do if you're sort of traveling back and forth? It's it's not necessarily, depending on the situation, you may be traveling back to work, to either attend meetings or meet with clients or whatever it is. The wrinkle here is that as soon as you're physically back in the United States, the source of that income is back to the US. So, you have to then source that income to the United States and sort of like bifurcate your tax return, the income for where it is. Now, I mean, it's important to note that as a US citizen, your worldwide income is taxed. So facially, you're subject to US taxation no matter what. However, there's sort of two main things that sort of mitigate that. So even though you're being taxed in that foreign jurisdiction, the US government is going to say, yes, we are US citizens, so we can tax you. However, there's the foreign income exclusion. So I believe that's, I don't remember, I think it's 103,000. I could be wrong on that, but there's a foreign income exclusion that basically, if you're earning that cap over 100,000, just over $100,000 abroad, the United States just excludes all that income altogether. So you basically report it, but there's no tax on it. The other way to get around it is the foreign tax credit. And this is to the extent that the foreign jurisdiction does tax you, they sort of have the first bite at the apple, then you get a credit against your US taxes. So the result of this is that most foreign jurisdictions have higher taxing regimes than the United States. As a result, the foreign tax credit and or the foreign income exclusion usually shelters 100% of your income to the extent that it's foreign source. However, if you're moving back to the United States, those foreign tax credits and the foreign income exclusion don't apply to that. So that's really why this is important. So kind of you can't shelter the US source income even though you're only back for a few days, for instance. So we touched on this before, these PFICs. So I mean, if you have like a retirement vehicle, whether this is something your employer provides you or some kind of small business version of this, the fear is that it is a PFIC, a passive foreign investment company. I mean, the definition is here. It has to do with the income that's passive and or the assets of the company are passive. The problem is that back in the day, this is a relatively old regime. I mean, the point of it initially was to sort of stop people, US persons, from parking their money in kind of foreign passive investment vehicles and deferring the tax kind of indefinitely. So, so Congress develops this regime to kind of to find it and tax it either currently or with a penalty if it's not done currently. The problem is that as the world has developed, a lot of these foreign retirement products, like not Social Security and not like a normal pension, basically everything else is, all these sort of defined contribution plans are all sort of investing in these generally managed funds like 401ks in the United States. And it's all of these products essentially fall into this bucket. And so why do we care? We care because, in addition to having, potentially reporting requirements, there is, like I said, a sort of current tax bite for what is otherwise passively accrued income. So, like in the United States, you take your money, you put it into the 401k, you pay tax on it then, but then you don't have to pay tax on the money that you contribute, and then it grows tax free, and you pay tax on it when you pull it out. Foreign versions of this act virtually the exact same way. You have to put it in tax free, it accrues tax free, and then you pay taxes on it when it comes out. The issue is that under the sort of like default provision of something that's a PFIC, if it's considered a PFIC, that money that is being deferred, that sort of income that's being deferred along the way, sort of accrues over time. And so it's as if the government was going to tax you for all the gains that you made in each year, every year, until you tax it out, but then they tax you on all of it at the end, plus interest. So what this has the effect of doing is sort of like eviscerating the tax benefit of the product. The whole point is that you don't have to pay current tax on it. Instead, what you end up getting is essentially the tax along the way plus the interest. So it ends up being a much larger number. The problem is that the solution to this is to actually just be taxed currently and every year. You can make sort of two different types of elections. One is this sort of mark-to-market election where you elect to be taxed each year based upon the money that you earn from the retirement plan, and you do get to offset it against the losses. So I mean, in theory, it's only on the gains. But you have to pay that every year, even though you don't necessarily have the ability to take the money out without a penalty. So you're basically being taxed now for a future benefit. It's like the reverse of what these things are supposed to be doing. There is another alternative called a QEF election, but the problem with that is that it usually has reporting requirements that aren't really attainable to sort of the normal 401k type investor person. It's really more like, if you were like a principal investor in like a hedge fund or something, you might have the records necessary to make this election. But for a normal person investing in like an index fund or some kind of regular retirement product, you likely can't get your hands on this type of information. And it is slightly more favorable, generally speaking, than the mark-to-market election. But because it's not really available to most people, your options are either paying the tax along the way or having a huge tax bite at the end, more than you were very likely expecting. So, if you know about this right at the beginning, it's not as big of a deal, because these gains are not necessarily, huge on a year-to-year basis. You can anticipate them. You can kind of factor them into your life. The issue is really people who have invested in these things for years, and now they're sort of stuck with the hard choice of, do we make the election now, essentially bite the bullet now and pay a big chunk now, and then sort of pay a little bit more along the way? Or am I going to wait until the end and deal with a potentially much larger problem at the end? So these are like radioactive. And so it doesn't mean that you shouldn't, as I tell people, if your employer is going to give you a retirement money for a retirement fund, like you don't necessarily say no. You just have to be aware that this is a potentially a large issue. So, in addition to people moving and working abroad, a lot of folks, move to foreign jurisdictions, Israel in particular, to retire. Their kids are there. It's a beautiful country. It's got, it's a wonderful place to retire. And so folks are, they move abroad because they want to, go to a nicer place than where they ended up, hopefully with better weather. So the sort of main, sort of like the super benefit, at least with regards to Israel, has to do with Social Security payments. Social Security is just not taxed in Israel, either by the United States or by Israel. So you actually get this is even better than being in the United States. In the United States, you get taxed on 85% of your Social Security benefits. In Israel, neither Israel nor the United States taxes Social Security payments. So, you effectively get like call it like 15, 20% increase in the payments because you don't have to pay taxes on it. The other thing to sort of note is that there's a special law that they passed in, I think it was 2008 in Israel, where if you go and you make aliyah, so if you are, if you're moving and you become a citizen of Israel, not just there, not just like a resident, but you actually become a citizen, you get 10 years where you don't have to pay taxes on your foreign sourced income. And this includes things like pensions and payments from capital gains, dividends, this passive type income, which would be sourced to you otherwise pursuant to in Israel, because you're physically there, but you also don't have to pay tax on it in Israel. So you have sort of 10 years of it being, kind of tax-free, essentially. After that time period, it just kind of falls back into the normal regime, and you basically have to, what we were talking about before, where you have either foreign tax credits or foreign income exclusion to shelter the income, but you're going to be paying tax on it in Israel, or any foreign jurisdiction, depending on where it is. Another question that was raised, before the presentation had to do with real property and 1031 exchanges. So high level 1031 exchange is when you exchange property for other property, and then you don't have to pay taxes on the gain because you essentially roll it over into another piece of property. The 1031 rules are clear. Domestic property and foreign property are not considered like kind for the purposes of 1031. It has to be a like kind exchange in order for this to work. So you cannot exchange domestic property for domestic rental property for foreign rental property. Interestingly, all foreign property is considered to be the same. So if you have, a foreign, a rental property in Milan and you want to sell it and then buy one in Paris, that is okay. That's considered to be the same. But if you want to sell it in, Washington, D.C., and then purchase it in Tel Aviv, that does not work for rental property. However, there's another sort of similar type regime that people are probably more familiar with, which is 121. This is the personal residence exclusion. This is if you sell property, your principal residence, you can then sort of roll that over into new property and shelter a lot of the gain. Interestingly, 121 is agnostic as to where the property is, period. So you can buy and sell your principal residence sort of no matter where you are, and take advantage of it. So as a planning technique, in theory, you could, take your personal residence, sell it, move to Tel Aviv, and then live in that jurisdiction, live in that as your principal residence for a period of time. And then after that, sort of convert it into a foreign rental property. And then at that point, you could use a 1031 exchange to sort of change rental properties. So, that's kind of, you have to be sort of really invested in that strategy for it to work, but it is technically available. Some other things, and I know we're sort of running out of time, so I'll try and be quick about it. For folks who have non-resident alien spouses, this is sort of a big issue. You move abroad and you get married. You can't, whereas in the United States, you can kind of gift between your gift between spouses is, it's not a thing, it's not sort of tracked. If you're gifting to a foreign spouse, the IRS does care. So you're limited to $155,000. Where this really sort of trips people up is where, if you take, US source, you have like a bank account in the United States, you move abroad and you purchase and you purchase property, that's essentially considered to be a gift to that other person. If it comes from, not a joint bank account, but from a joint bank account, from a single bank account to a jointly held property, that's like gifting them half of the amount. So depending on the value of the property, it's something that you have to consider. It is an annual limit. It is not a lifetime limit. So it's each year. So there are, in terms of planning, there are ways to sort of structure these kind of things. With real estate, it's difficult. You'd have to sort of purchase the interest sort of ratably over a period of time. But with marketable securities or with money, you can definitely kind of plan around it, sort of like as you would in the gift context. There is a way to sort of elect out of this regime, is to treat the non-resident alien as a U.S. person, but you have to be very, very wary about that, because then that person is treated as a U.S. resident. And so they could conceivably fall into the F bars and the PFIX and all these like alphabet soup of things we were talking about. Now they have to be on the lookout for that. So in a limited situation, maybe you want to do it, but you have to really know what you're doing if you're going to do that. So the other thing to talk about is sort of estate and gift tax considerations. So unlike we know the estate tax exemption for U.S. persons is at it's like $11+ million individually and $22+ million for spouses. If you are a foreign person and you have U.S. source property, then that exemption is only $60,000, which is obviously, orders of magnitude less. It's a completely different calculation. It basically hits everything. Any piece of real estate virtually, you could have appreciated stock. An interesting thing to note is that stock of a US company, so like Apple, Google, whatever, while you're alive, if you gift it, is not considered to be US source property. It's sourced to where that person is located, but when they die, it's considered to be US source. So the exemption there is only $60,000. The reason why it's important is, again, with sort of, touching on both, your foreign family could have entanglements in the United States, which might cause a problem for this, or you might have a spouse, who's not a U.S. person who owns property, and then it also kind of creates a problem where it wouldn't ordinarily. There is some planning techniques to go around that, to essentially convert like a real property into essentially a stock by putting it into a corporation. And that's a way to kind of get around these issues. But, it's another thing that you kind of have to be on the lookout for. And sort of real quickly before before the end of the hour, just because you've left the United States doesn't mean that you necessarily don't have state tax obligations. First of all, in the year that you move, you're going to have state tax issues. Eventually, like when you're there for a while, you won't necessarily have to file a state tax return. But before, when we were talking about going back to the United States, you are going to have, in addition to federal income tax liabilities, state income tax liabilities, in the state that you are conducting work. So that's another kind of toe trap to kind of to worry about. As Mark kind of mentioned in the beginning, we have, this is a lot, and people could probably thinking about themselves, I already have, things abroad, and I never knew about any of these things before. There are ways to sort of get into compliance. The earlier, the better. Knowing about these things and being able to address them head on is much better than kind of waking up to, a love letter from the IRS. So, there are, and these are, we do a lot of these things to sort of getting people into compliance, either before they move or once they've moved over there, to kind of clean all this stuff up and put you on a firm footing going forward. Unfortunately, it appears that we've run out of time. We didn't get to a lot of these questions, But, I would encourage you all to reach out to us individually. And, we'll be happy to either, set up a time to talk one-on-one or try to address the concerns via email. We're available, and I hope that you guys found this helpful um, and and for your ongoing um, endeavors. Um, yes, we will be setting up the slides.
Yeah,
Okay.
we'll follow up with an email with all the slides to everyone who's attended after.
Right.
Okay. Well, I'm getting some waves, so I mean, we can try and run through these as quickly as possible. So I got one about foreign stock reporting. Does that include publicly traded companies headquartered abroad? No. I mean, the things that are on the, U.S. Stock exchange, like that's not. We're talking about privately held. Mark was talking about privately held companies, like just because you buy, like Nestle or BP, on the New York Stock Exchange does not sort of give rise to these 5471 issues. I think we addressed the question about if you're going back and forth. If your main residence is the United States, then I don't really know what that's touching on. So the residency rules are there's like a whole tiered approach to it. Basically, basically not exactly, but if you spend more than half the year abroad, then you have to be on the lookout for, are you a foreign resident? And that's when all these, there becomes kind of like a sea change. If you're spending more of your time in the U.S., then you're going to be, a U.S.
Right.
resident, but you still have to be on the lookout for foreign source income, even if you're not over there more than half the year.
And the one thing to keep in mind with that too is the tax treaties, particularly if you have citizenship in both locations, will sometimes have override provisions on some of those things. So it may say, even though you spent more time in the U.S. in a particular year than you did in Israel, for example, there may be under the tiebreaker rules there, they may still consider you to be an Israeli resident for tax purposes that year. So it definitely, and of course, not all treaties are the same. So the tiebreaker rules aren't the same across all the treaties either. So just be cognizant of that. But it really is sort of like Jeremy said, it's kind of a sort of a rolling average of the amount of time you've spent in the U.S. To determine, assuming you're not a U.S. If you're a U.S. citizen, then this whole thing kind of goes out the window. But if you're not a U.S. citizen and you're back and forth, then it's, obviously it makes a little bit of difference to determine how much time you're here or not.
As for the foreign property sold, yes. So, excuse me. So it's going to again sort of be where you're a resident. Well, foreign property is going to the first bite at the apple is going to be the foreign jurisdiction, generally speaking, pursuant to most treaties, Israel included. It is subject to capital gain, but to the extent that it's taxed in the foreign jurisdiction, you might get credits for it. So, I mean, sort of they get first bite at the apple, which will most likely make it not taxable in the United States. What consideration to be made for remote workers in COVID-19? For example, several Caribbean nations introduced the remote work visa. Yeah, I think we sort of touched on that. Basically you have to just be aware, basically the income is being earned where you are physically located. I think
that might be it.
I think that might be it. Oh, there was one question from that we got before I didn't touch on, which is the person asked a question about if the overseas employer is the U.S. government themselves. So I guess like this is if you're like in Israel and you're working for the U.S. and you're a U.S. citizen and you work for the U.S. consulate or the embassy, that is U.S. source income. So the treaty, it's Article 22 of the U.S.-Israel Income Tax Treaty. And so that's an issue that's sort of specifically addressed. Other than that,
And one thing to keep in mind too, if you're an employee of the U.S. government, even if it's not covered by a treaty, you're not that income is, as Jeremy said, is always U.S. source, and so it's going to not be eligible for the foreign earned income exclusion. So that 103, or I think it's up to 107 or so for 2020, that private individuals working for private companies abroad get to exclude. If you're there as an employee of the U.S. government, that won't count. So just be cognizant of that.
and the sneaker in right at the end, the EU does not have a single totalization treaty with the US. It is these treaties. The answer is no. So it's on a country by country basis. A lot of sort of Western European countries have them. The Eastern Bloc doesn't necessarily. So you can literally Google globalization treaties, and there's a list of them. So thank you all for coming, and please reach out if you have any further questions.
Yep. Thank you all for attending. Really appreciate it, and enjoy the rest of your week.